Another way that I see is participating in multifamily conferences. Show up at a conference and talk to people and talk about what skills you bring to the table, what it is that you've developed against your strength through your educational process, through your career, through other activities in your life. Everybody has them, and it doesn't matter what your career is, what career path you've chosen, what jobs, maybe you have 2 or 3 part-time jobs. It doesn't matter. You have skills that you can offer.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with John Todderud. John is a multifamily investor and syndicator who focuses on sourcing, underwriting, sponsoring, and capital raising for deals. He began his real estate during his software and technology career, which I'm sure we'll talk about that background, John. As I mentioned, I like to let the guests tell their story, so I won't give away too much here. But I first want to say thank you for coming on the show today. Thank you for taking the time out to chat with me and my audience. I'm very excited to have this conversation.
Jason, thank you for inviting me. I'm thrilled to be part of it and share my experiences, good and bad, and hopefully offer some insights into things that help listeners move the needle and get a little bit farther in their business and develop an interest and a passion like we have.
Yeah, that sounds great. And I love that you mentioned the good and the bad, because I think actually both can be helpful. So
yes.
With that, let's just start with your story, your background. Sounds like you didn't weren't born into real estate. So let's hear a little bit about the background and the transition and all of that.
Sure. Yes. I mean, as you mentioned, I've had a career in technology in various aspects of it. First in software engineering, managing software developers. Had my own software business for about 10 years, developed the product and sold it and did well with it, and then moved from there into consulting and other types of technology related opportunities. All good jobs, fun, enjoyed meeting people and enjoyed the social interaction part of it. I'm not a heads down in the corner and don't bother me kind of tech person. I work with a lot of them and they're awesome people and you just can't do without them. But I spent my tech career engaging with other people. And so somewhere along the line, probably about 18, 20 years ago, I developed an interest in doing other things. Like I've had my stock funds and 401ks and that kind of thing. And they're up and they're down and you have no control over it. I just wanted a little more control over it. And I felt like I've got a little bit of I should say a fairly strong entrepreneurial interest and passion and have pursued it in a number of different directions over my career and thought real estate. I looked at real estate and I thought it'd be a great application for the things that I already know, and it would be fun to go out and kick the tires on properties and look at them and learn about that whole business. I also knew a lot of people have developed their success through real estate. It was clear that it's a path. It's not the only path by any means, but it is a path to pursue. And so I wanted to give it a start. And my timing was about 2006, 2007 or so, and talked to friends, and they were, trying to get them interested in joining me on a real estate deal, whatever that is, like a single family home or a small multifamily or something. I just didn't know. I was thinking real estate, and we talked about it. And we procrastinated and delayed and discussed things and discussed them some more. And next thing you know, it's 2008, and the crisis came. The drop in everything in the economy, the stock market and real estate, and the mortgage-driven drop in the whole real estate market and the economy came, and then real estate prices, of course, tanked and took a long time to recover. I was very thankful I didn't own anything. I was just lucky, not because of my foresight or anything. I just didn't own anything at the time. And so 2009, 2010 roll around, and I'm thinking, well, it's probably not going to get any worse. You never really know. At any particular time, nobody knows for sure what's coming in 6 months or 1 year or whatever. And so, but I thought it'd been stable and bottomed out, and I got back. I got back into my interest of real estate and looked around and bought one. I bought a 3-unit property the end of 2010, and then bought a 4-unit a few months later. And so I had those, and they were right down the road for me. Half an hour away. I could maintain them and take care of them and find tenants and write leases, and had to learn rental law. I mean, really, I had to learn everything. It was just like a learning environment. It was a college education, if you will. I didn't know, I didn't have the tools or the skills for even determining, is this a good deal or not? It looked like a nice property, and I figured I could make it a good deal. And there were short sales from banks. There's a lot of those in the market at the time. So I thought, oh, has to be a good deal. But I didn't know. And then so I worked on it. I did the work. I was fixing them up. When you had a tenant turn, and I was learning about all those different processes about, me doing the work, and then finding contractors or people, other types of handymen to do the work, and getting help and support where needed. And I met people who were doing similar things. I got invited to meetups and started networking, the whole networking thing, and it expanded from there. I heard about a multifamily conference and went to that like a couple of years into my ownership of these properties. And I one of the things that I was thinking was that, I'm kind of tapped out here. I can't go buying a whole bunch more properties. I don't have that spare cash in the bank. And so what do? I've developed these skills, and the answer is pooling other people's money together and getting other people to join you on deals, and figuring out that whole model. And so this is a couple of years into my ownership, I started down that path, learned about syndications, and met people who would be prospective partners, and decided to pursue that. And that was probably about 6 or 8 years ago, and did our with the team did our first syndication. It was a property in South Carolina. I like that market. So one of the things that, not to go too off on a tangent, but I had sold the first 2 properties and bought other properties across the other side of the state. So I was no longer. My state is Washington. I'm from Seattle, and these are like right down the road from me in Seattle, and then Eastern Washington. Nice markets and decent properties, but I wasn't next door. I was like 3 hours away. And so it was my training in how to work with property managers. And I realized through that experience that you don't have to live next door to the property. You're managing a property manager, which is the mode I wanted to be in. And so I figured I can buy anywhere in the country. Wherever there's a good market, I can buy there and manage a property manager in that market. And so that's what I did. I found the first syndication in South Carolina, a good market, upstate, outside of Greenville, and we syndicated that and owned it. And I tried to find more properties there, and it's a very competitive area. It still is. It was at the time. Mm-hmm. It's even more so now because they're nice. They're nice areas. They're building new properties there, and people are moving down from the Northeast, and very pleasant, comfortable style of life, and desirable for good reasons. It's just a nice area, and so there's a lot of demand for multifamily there, and I thought it's a little too competitive for me, and I just started looking in the Midwest, and have since then have done more syndications in the Midwest, and that's what I still do today. I spend my time looking for properties, and I can leverage my tech background and my experience with tools. I'm good with numbers and with spreadsheets and other software tools, and comfortable in that space. So I do underwriting, and I do sourcing. I talk to brokers, have broker relationships, and I'm out looking for deals. And in my partnerships, I have people who do similar things, but also complementary things. People who understand the properties and the day-to-day operations and deal with investors. And, there are things that any of us can do or figure out how to do, but there are a lot of people who do them really well. And I partner with those people who take care of those aspects of a syndication. That's kind of where I am today, still doing that part. Yes.
Yeah, no, that's great. There's a lot of, I think, tidbits in there that we can break down and talk about, because I think that,
yes,
even just sort of that start into real estate, the sort of procrastination part of it, which turned out in your favor. It doesn't doesn't always turn out in your favor, but certainly in that instance it did. I think but the reality is that you eventually did get started, and you started with, I think, what a lot of people feel is like the most comfortable place to be, is like something close to home, something smaller, that kind of
yes.
thing. Sort of learn the ropes. And I think that it's you made a comment, sort of, I think, about getting a real estate deal. What does that really mean? And I think that for so many people, being in real estate just means one thing, or they don't know what it means. And I think that it's a good thing to point out that there's like probably an infinite number of ways to get involved in real estate. And it's like, that may be part of what holds people back. Part of what holds people in that procrastination mode is that they're like, well, what do I do? Where do I start? What's the right thing for me? Do you feel like that's the case? What do you think about that? Kind of any advice to help people get past that sort of initial fear of jumping in, the procrastination, whatever it is, you want, limiting beliefs, anything you want to call it. But do you have an idea around kind of what's a good way to bridge that gap?
Yeah. There's two sides to it. One is you could be studying these things to death and end up never doing anything and waste a lot of time. The first thing you have to answer is, how committed am I? Can I find the time during the day? It's like you might think to yourself, oh, I want this so bad, and it's really my direction for the future, and I know I'm just made to be doing this. And okay, that's a good mindset to have. But now, have you figured out how am I going to accomplish this? Where am I going to find time during the day? Do I have a job that I can maybe do some work in the morning, take a break in the middle of the day, do some more work in the evenings or the weekends, or do you have other commitments? Are you so fully committed that you'll just never find that time? That's the first thing you have to resolve, is finding the time. Then you need to be looking at it. And I went through the same thing also. I was thinking about single family homes and talk to people about fix and flips and wholesaling and all that. Those are great options. They are. I almost did those. I chose not to. My reasoning was it's just a one hit, and then you're on to the next one, and it's constant. And I wasn't really looking for that. I was looking for something to do a lot of work at the beginning, and then have sustainability, income from it, and then grow into bigger properties and be able to leverage the skills that I developed on the smaller properties into the bigger ones. That's just me, though. And I would say what somebody needs to do is figure out what your strengths are and where you can get started. If you're like new in your career, and you don't have a lot of savings, then number one, it should not mean you can't get into real estate. That's just a fallacy. You don't need all the funds in the world to start into this. A small amount of funds can get you started, and if that's your case, maybe a direction like helping somebody out in a wholesaling or single family home to get started or get your foot in the door might be one way to do it. Another way that I see is participating in multifamily conferences. Show up at a conference and talk to people and talk about what skills you bring to the table, what it is that you've developed and is your strength through your educational process, through your career, through other activities in your life. Everybody has them. And it doesn't matter what your career is, what career path you've chosen, what jobs, maybe you have 2 or 3 part-time jobs. It doesn't matter. You have skills that you can offer, and you should be identifying them and be able to speak to them. So you show up like at a networking event and say, I can do a lot of things. Bringing a huge amount of capital to a deal is not one of them, but I can do a lot of other things that a multifamily team buying a multifamily, like an apartment, will need. I can do those things, and there's a ton of roles that you can fill out there without bringing a lot of capital. Those are other ways to get involved. And then you're on the management team. You're a partner in the management team and a general partner, and you can grow from there. You talk to other partnerships and say, I've done this and I have X number of units that I am a manager on. And that's a very strong statement to say about your background. And you're working hard at it for that property, but you're also moving on to additional properties, and you can do more and take on more things. Like the roles could be, you're putting together the investor reports at the end of the month and sending them out to investors. Not a difficult task, but it has to be done correctly and it has to be done on time. And it can be easily taught. You can do those kinds of things. In the course of managing a property, I mean, we've had a lot of occasions where, we need a security system for a property. And on the one hand, you've got a property manager. Tell the property manager to go research security systems. Who in the market provides them, can set up the cameras and the computer and the networking and all that stuff. That's great. Your property manager will do it when they can find time. You might want it sooner. You're going to look it up and find 6 or 8 different providers in that market and call them yourself. That's not hard to do either. You're just keeping track of it and doing these simple tasks that a general partnership wants somebody to be able to do those things, and they look for somebody that they can give you assignments, and you're embracing them. You're saying, yes, I want to do that, and jumping up and doing the task. That's your role. I mean, you can call it what you want. You're in the middle of operations, but those are very effective ways of getting started. A whole lot of successful people have done that without much cash out of their pocket. So.
Yeah, that's
different ways,
and that's a great point in especially in regards to within a syndication, and probably not something I've heard anyone mention before, but that would be a very valuable role to have on the team, is someone who is I mean, the word that comes to mind is like a runner. That's kind of from the construction world, but like, someone that does a kind of, it just does things that need to be done, right? Like they, on that,
yes.
Like you said, you mentioned the researching security systems. It's like someone who can make things happen quickly would be, and that's a part of the asset management role. But, if you have a person who's asset managing multiple assets, having almost like an assistant to that asset manager would actually be quite a valuable role. And yes. Some people that have large companies, large syndication companies, they might have that role as an employee, but not every syndication does. A lot of times it's a group of individuals who have partnered together. And so, that's a very good point for someone who's just kind of a, persistent personality that's like, we need this. I will work on it until it gets done, and that kind of keeps going yes. in that regard. I actually like that a lot. I think that's a really good place for people who want to start in syndication and maybe don't have a lot of money or the network to raise capital to get their foot in and learn operations very, very well.
Yeah, it is, and like you said, there's 100 other ones. I mean that the idea of I'm going to go out and join a syndication where they're buying a 50 unit or 100 or 150 unit property. that's crazy. They'll never want me. I don't have anything to bring to them. And number one, you're wrong. But number two, if that is too intimidating, there are a lot of other options for it. You're going to go around and do the phone calling yourself. Look at a given market in your state, maybe a smaller market, other markets that are not so heavily competitive, and find owners of 10, 20, 30 unit properties in that market and talk to the owners and get to know them. You're not saying, hey, I'm interested in buying. Would you please sell to me, or what price would you need, or anything like that? That's a conversation for way down the line. You're just getting to know people and saying, I'm getting started, and I notice you're very successful, and can I buy you a cup of coffee? And take a road trip to their market and buy you a cup of coffee, that kind of thing, and get to know them and know several people like that. And over weeks and months, and at some point they're gonna say, hey, do you have an interest in buying my property? Those are some things you can do. And if you find a property, then you're also talking to other people in your network and saying, are you looking for properties? And so you might be able to join a buyer who doesn't know how to source a property with an owner who's thinking of selling. You're kind of in the middle. You're not a broker, but you're going to be part of that deal. You source that deal, and you're not putting a lot of your money up, but you did a very valuable role in that whole process, and people will value that. That's just your phone calls, taking a trip once in a while, getting to know people. You're not going to get paid. This is another thing to be aware of, is these are not getting paid by the hour jobs. You probably won't get paid much for your first deal or two. You're going to spend some time. It's hugely valuable experience. You got to look at it from that perspective. These are not things where you're going to cash in right away. These are developing your experience. You got to be patient, and you got to work it for the long term.
Yeah, and that point actually reminds me of something that you said, kind of initially, speaking of people deciding, kind of that real estate is in their long-term plan. And again, that goes to whatever capacity you want to be in, whether you're going to be an active or a passive investor, whatever asset class, whatever role, but ultimately really truly looking at it as a long-term plan. What people,
Yes.
As you mentioned, you thought about flips. Doing flips is a business. It's a business, in a transactional business within real estate, and it's not a bad place to be. It's just you're right. You're gonna make that money, move on to the next one. If you really want to make money in flipping, you need to be doing a lot of them and having big crews. So but even all the really high volume flippers, what they end up doing is keeping some of them as rentals, or taking that income and then investing it in long-term rentals. Like, you have to look at it as a long-term game. And I would say, just kind of revisiting that point about people thinking about getting into real estate, and this piggybacks on what you said about you might not make a lot of money in the first couple of deals. Like, you do have to look at it in a much longer term or longer range time scale than most people look at things in general, right? Like, it's like you see on HGTV, you see these flip shows, and it's like, oh, look what we did in 6 months. And it's like,
Yeah.
I made all this money in 6 months. That's amazing. Like, that's great. Like, it's not bad to make, $100,000 on a flip in 6 months. But what if your flip doesn't go well? Like, what if you have, we're going to get into talking about current markets, but what if you're in the midst of real estate in 2007 and the markets crash, or you're in the midst of real estate in 2021, 2022, and the rates double overnight? Like, those things come up. We don't know that they're going to come up. Like, in hindsight, you could probably say there were some indicators on both of these events, but like, you don't know truly what's going to happen. And so I think that the idea is that if you look at real estate in the time frame of 3 months, 6 months, even a year, it's not looking long enough. And so I think you really do have to think about it as you're making this commitment for, the lifespan of a deal, whatever that one is, kind of expected to be. And it might be longer than that. Like, you might think it's going to be 3 years and it'd be 5, or 5 and it'd be 7, because if you can ride out the real estate market, it is going to move in the right direction. So I just think that goes along with this, kind of getting started in the space, where if your role is that, assistant or runner role, you probably, like you said, you're not gonna make an hourly wage likely. You will probably get compensated as a percentage ownership, which may or may not mean you get really anything until that asset sells. But again, you said developing valuable skills, growing your network, and building that for larger things in the future. So I think that just kind of all ties together on some great points there.
Yes, and I would say that the properties that I've owned that have beat my expectations, they, they didn't. It was not a steady climb. It was not a straight line up and to the right. It's a
Mhm.
lot of ups and downs and periods of time where it's so frustrating that you kind of wonder, what are my options at this point? One property in particular was having a number of things that are falling apart on the property, just a high number of repairs, and tenants were starting to complain about it, and they were complaining to the local city planners or permit people or city inspectors, and the city came down on us pretty hard. They mandated a number of things that had to be fixed, and this is years ago. Today they're doing that more often, and I think they've got a bigger stick,
Yeah.
unfortunately. But back then it was still brutal, and so I had to dig in and spend on types of things like replacing a roof, because some of the upstairs units had water leaking, and we were fixing the water leaks, and they were still complaining, and it just wasn't getting fixed well enough. And
Mhm.
and we owned that, and so we replaced the roof, spent the money on replacing the roof and some other things, and then it worked out. We were within a couple of years or so, we were able to sell the property, and total returns were very strong, and we were extremely fortunate because we got it in stable position, stable type of situation there with that one property. Another property had to go through property manager changes and had experiences with certain crime types of issues at the property, and then we started seeing opportunities for increase in the rent. The new property manager units looked good, and we could push the rent a little bit more. And the timing, I mean, the market helped in this particular case, but the timing worked out well, that we did really well, a lot better than expected, in a market that was just a pretty good market. I wouldn't say it was a spectacular market. It wasn't going to be red hot or anything like that. It's primarily an agricultural market, but there were other things going on, and this property just did really well. And you never know. You can't predict it. It's just that it's bumping along, and yeah, maybe you're getting good cash flow from it, but you don't truly know the value of it until you put it up on the market and you see what people will pay. That's what determines the value. And in this case, the value is very strong. In other cases, it's not been as strong, and but you can hold on to it, and you do the right things. You make the property look like a comfortable place for tenants to live. If that's your focus, you're going to do well. If you're thinking about the property needs to attract good tenants, then I can get a higher income, and then I can get the valuation out of it. But first, you have to do well by your tenants, and then the other things follow. And if you're focused on that, then it will turn out well, but it's not going to necessarily turn out well right away. You don't look at especially on an apartment. If an apartment building is not a fix and flip. I mean, some of them can be, I guess, but low occupancy or distressed or something like that. You're thinking you're going to buy in, you're going to do all the work and get all the units renovated, and then you're going to sell it. That doesn't usually work too well. It's still a longer term proposition, and you have to have that mindset going into any of these apartment deals that you're going to hold them for a while, but you will do well. And
Yeah.
you'll see other people who have similar stories, and they work out well, but not right away, not in a month or 6 months, even in a year. It takes several years for these things to turn around, and then you do really well.
Yeah. Yeah. 100% agree. I think all of those, it's it's eye opening to, when you're getting into the space to kind of, I guess, come to that realization, have that, have that recognition that like,
Yeah.
oh yeah, it's like what you see maybe on social media, things like that, where it's like, oh yeah, we went in, we bought this and we renovated every single unit, and then we sold it for twice as much in 18 months. It was amazing. Like some of that happened, but most of that is going to be, if that happens, it's because of market conditions more so than you just were able to have everything go perfect in that amount of time. You have to figure it's likely to not go perfect and probably take a little bit longer to accomplish the business plan than you expected. And we just have to ride through that. And like you said, that might mean longer time. It might mean you're going to have to invest some money on a roof that you didn't really plan on, that kind of thing. So it's just
Yes.
being conscious of just the possibility or the likelihood of hurdles coming up along the way. I think that's recognizing that that's the reality of this business, and then just being okay with it. So John, you mentioned that you had invested in that apartment complex in around Greenville, and then kind of shifted to the Midwest. You said it was because of just competition. What do you like about the Midwest? Aside from lower competition, how has that been? I have not invested in the Midwest. I actually, oddly enough, don't feel like I've had a ton of guests that have focused in the Midwest either. I know that people do. Like, talk a little bit about, sort of your markets there, what you like about it, kind of how you might compare it to, people like to talk about the Sun Belt a lot, but I think every market has challenges. So I'm interested what your thoughts are on just specifically where you're investing now.
Yeah, glad to. I started looking there for the reasons that you mentioned, that it was very competitive in these Southeast markets, the Carolinas, Georgia, Tennessee. The cap rates were very low. Wasn't much cash flow in properties that you're looking at. The winners of these bids were bidding numbers that there was no cash flow. They were expecting to be able to bump rents significantly and make the investments, and more power to them. A lot of them did really well, and they're still good properties. And there's like 20 or 30 or more offers on a given property. It was just overwhelming. And I chose the Midwest for several reasons. They are strong, growing markets. They have jobs coming to them. They have employers building new employment centers, whether it's plants or manufacturing or technology, in some of these cities. Not all of them. You got to look at where use your emerging market metrics. Look at things like jobs growth and household incomes and affordability and those kinds of things, and find good cities. I chose them for that reason and started looking. And so my markets are like Kansas and Missouri, Oklahoma, like Kentucky and even Arkansas. I'm not in Texas or Arizona or Florida. Those are awesome markets also, but they're just a little also too red hot for me. And what I've discovered after buying and holding in those markets is that there's a high level of recession resistance in those markets, that they're not going to be the same peaks as, say, Phoenix or Dallas are, but at the same time they're not going to go tanking like those markets do when the market shifts. Like what we've seen over the last year or two is the rent growth has stopped and it's become negative in some of those bigger markets. That's temporary, and it's for a lot of other reasons, like they're getting overbuilt and things like that. It's not because people stop moving to those areas. There's still strong areas. Dallas, all the markets in Texas, they're just very strong. They're super competitive, but they're going to stay strong. They just weren't markets for me. I wanted markets where I could get in there and compete, and I found it to be successful. I found that rent growth, like one of the strongest rent growth markets in the U.S. now is Louisville, Kentucky. I like Louisville. I don't own a property there, but I'm looking. It's not that they'll continue to be the rent growth kings, but places like Kansas City, I do own in there, and I'm looking for more. And some of those other markets, they've just proven to be resilient. They haven't taken the dives that other markets have. They're not getting overbuilt, and I see a lot of businesses still migrating to those markets. The landlord and ownership laws are very favorable toward landlords and owners, and so they're good investable markets. You're not going to see necessarily. I mean, for the properties that I look at least, they're not going to be a ton of offers on these properties, and there's cash flow pretty much. I mean, if it's a stable property, pretty much out of the gate, you're not going to be waiting for 2 years to get cash flow out of a property like that, and you don't, and they're stable. Well, I should caveat my goal or my target is generally stable properties. I like properties with older interiors that there's an opportunity to upgrade them and do renovations and see an upside potential where there's enough of a rent differential. Maybe an owner kept rents lower than they probably should have, but those are good opportunities. You do some work and make the units look real nice, and then you can rent it out at a somewhat higher, maybe a lot higher rent than what they were getting before. Those are the opportunities I look for. That's where you really create value in a property, and those are my targets, and I can find them that are still stable in these Midwest markets more so than I could in some of the hotter markets in the Southeast and the South in general. That's where I look there.
Yeah, I mean it's a great strategy, and I think one thing that I maybe didn't think about early on is people talk a lot about diversification. I think diversification of markets is probably a very helpful strategy as well. Whether you're active in all those markets, or maybe you're active in some and then investing with other people in other markets that maybe aren't your target as an operator, I think it makes a lot of sense, because if you've been investing in the Sun Belt or some of those hot markets in like Austin, Texas, I think people made a lot of money in Austin, Texas, but also right now it's a challenge because that those values have probably dropped more than other markets because it was such a hot market. And so I think if you have some of your assets in those type of boom markets versus some in the more steady, if you will, markets, it makes a lot of sense. And I think that it's just something that the latest market cycle has maybe changed how at least I've looked at things, and probably how a lot of people have looked at things, in terms of, there's probably not only one good place and one good asset to invest in. It's probably a lot smarter to be kind of truly diversified, and figuring out how that looks for each individual is an important piece. What do you think, or what have your thoughts been on, kind of the last couple of years? What have your experiences and thoughts on kind of where you see the market going? I know nobody has a crystal ball, but just want to get your opinion really on what has happened recently and what you maybe see coming over the next year.
Yeah, I mean, my vision for what's coming in the future has gone from clear to cloudy and clear to cloudy, and it just goes back and forth. I have always thought that better opportunities for buyers and sellers is around the corner, is coming up, And I've thought, the market's been down for quite a while. I mean, I've been looking at it since 2002. Interest rates have risen. They started spiking in early 2002, and I shouldn't say spiking. It was a gradual increase, and they that made it more difficult for buyers, and transaction volume, the number of properties being bought, declined over that time period. And since then, we've seen interest rates stay very high for people buying a house. Personal mortgages, certainly they're high, and that's a pain that a lot of people feel across the board, whether you're with an investor or not. But the market for commercial real estate, commercial multifamily in particular, we're out using a different type of loan structure, but still the rates are impacted by similar things. Different, it's a commercial loan is probably going to be driven by the 10-year treasury yields or 5-year or some kind of measure like that, with some other things. But yes, rates are high. That's held back the market. The other things going on are when rates were lower is when contractors, general contractors, and buyers and builders started building properties and adding more units to the markets. And so some of the bigger markets in Texas and Dallas, Phoenix, just had a lot of new development, and that started a couple of years ago, 2 or 3 years ago, when rates were low, and now they are getting finished. The properties are put on the market, and there's a lot of new capacity in the market for rents. I mean, for units, apartments to rent, and that's held back rents. And a lot of people who bought investment properties with an expectation of being able to raise the rents have not been able to see that. And a lot of people who bought properties who they had a business plan to do some significant renovations over a short period of time, maybe a 1 to 2 year period of time. They're going to get the renovations done, and then they're either going to sell the property or they're going to refinance a higher loan rate bridge loan. And they've not been able to do that. A lot of properties have gone into foreclosure or had to sell for a lot less than what they expected because they had loan problems. Not necessarily that occupancy was lower or that there was any problems physically with the property, but their debt structure forced them into a bad choice. And those properties are on the market and dragging the market down. Multifamily valuations of apartments has been declined in a lot of markets, and this is not something that's true across the board either. I mean, there are markets that have remained somewhat strong. I mean, it comes back to my earlier point. I like Midwest because these types of whole market impacts are not necessarily going to hit a lot of these Midwest markets as strongly as they do some of the other markets that were super hot. And so what you see in the U.S. as a whole is not impacting every market across the U.S. I mean, in the worst recessions that the U.S. has had, there have always been markets that did not suffer downfalls. And so these are the things to look for in markets around the U.S. What I see is I think now is a good time to buy, but man, it's not the first time I've said that. I said that 6 months ago. I probably said it a year ago, and I still believe it. But rates jumped last year through the course of the summer at various times. Then they started to decline, and some things happened. The Fed got in, presidential election, and who knows what all is impacting these rates. But the rates we're looking at are impacted by various external events, and they're still not dropping. There's not a sign yet that interest rates for commercial real estate are dropping yet, and I think that's going to continue to have an impact on the market. There's a lot of money. It's not so much there's no money available. There's a ton of money. What I hear and read, there's a lot of money waiting to invest, both from private investors and institutional. When things do improve, hopefully they will in the next 3 to 6 months, then a lot of money should return, and hopefully that is a self-perpetuating cycle, that these things start to get good and everybody realize, oh, I better jump in. I don't want to miss the beginning of the next cycle.
Yeah.
So, yeah.
Yep. Yeah.
Wish there
It's
was a crystal ball.
I think it goes back to, kind of what we talked about earlier, is just, it is, it's a long-term investment, right? So it's like, you
Yes.
said, I said it was a good time to buy 6 months ago, a year ago. I say it now. That's because you're thinking of these assets as what it's going to look like in 5 years or 10 years. Like it's because, we don't, nobody knows what's going to happen tomorrow or even in the next month or 2 or 6 months. But we do know historically real estate is going to increase in value over time. And so it's like, if you look at it in a long enough time horizon, it's going to get better. And the fact is, now is a better time to buy than it was early 2022 when everybody was buying, right? Because because things were so kind of inflated, and we had, and more so just because of the debt structures that were coming. Most of everything that was bought there had to be bought through bridge debt, which was, short-term debt that didn't work out well, isn't working out well because interest rates changed. And so it's not even so much about like the pricing. The pricing goes along with those rates, but like the debt structure to me just has become so much more important. And so it's like, people talk so much about the rate. Like I want safety, I guess. I want a debt structure with multiple exit opportunities. I think is more like, I don't want to be forced into selling. I think that's where you get in trouble. And I think that's, to me, what's maybe the most important lesson of this last market cycle, is that you don't want to have to sell in 2023. No, you didn't want to have to sell then. That was a bad time to have to sell. But that also means it's probably going to be a good time to buy here, when it's a bad time to sell. So it's just, I think being cognizant of it being a long-term investment will solve a lot of those kind of short-term pain things, in that you just know you're going to be in it for years is ultimately the way to look at it.
Yeah, and I would also add that the bridge loans that have traditionally been available have, they are to get you to a fairly near term exit or transition or refinance or something. They have filled a critical need in the real estate market. There are a lot of properties that are in desperate need of improvement, of upgrades, and that's how an investor gets into it. There's a bridge lender. A bridge loan is a lender that lends under higher risk circumstances. They're going to charge a higher rate, and they're not planning to be in it for more than 2 or 3 years or so. And it's not a longer term thing for them. Ideally, less than 2 years. But those are really not options anymore. I mean, the cost of the bridge loan today is so prohibitively expensive that there's not much of that, hardly any of that going on, and that's going to hurt the market. A lot of properties, a lot of owners that are really done with the property and want to get out of that business, and buyers who want to put some money in and make it a really nice property. It just can't. A lot of that is not happening when it should, and so it's hurting the economy in general. It's hurting people who want to rent, and it's hurting the investors. The investors are not coming into the market for that reason.
Yeah. There's a number of factors there, but I mean, it'd be interesting to see what happens over this next couple, 6, 12, 18 months. Well, John, let me switch gears. I want to make sure I get to ask you the questions I ask every guest. The first one is based on the name of the show being Know Your Why. So what is your why? What's kind of driving you? You've had now multiple successful careers. What keeps you going and keeps you motivated?
To me, I've always wanted a social technical challenge that could carry me for as long as I had the energy to do it. I didn't want a career that I was just going to stop and abruptly switch and sit around and on the couch all day and watch TV. That's not what I do, and so this was an ideal way to do that. I wanted to grow more wealth for my family and be able to afford uh, some additional things in my family that make sure that my kids are well taken care of, and we can enjoy more family time together and have it sustained through the later years in my life. And so this was a good path to that direction. And that was my initial why, my initial motivator. My motivator since then has been that it's just a thorough enjoyment of all the aspects of the business. I like the aspects of looking at properties, even sitting at my computer and going through the numbers and seeing if it makes sense. I enjoy that part of it, but I also like going out and kicking the tires, like seeing the properties, visiting properties, and I enjoy going to conferences and meeting people because they're such a positive mindset people, and they're fun and enjoyable to talk to there and then get to know later and develop partnerships and really friendships with them. And so that's and that's engaging enough for me to continue pursuing it.
Yeah, that the positive mindset at a real estate conference is really pretty inspiring. Just everybody's got that kind of motivational drive. So it is really kind of a great thing to be around. So I agree that environment is pretty inspiring.
Yes. Mm-hmm.
When people hear this and they want to connect, what's the best way for them to reach you?
Well, I'll give you one main way. So my company is Cardinal Oak Investments. It's easy to find, cardinaloak.com, but there's an easier way to get to the company and to me, and that is through learnaboutapartments.com. I'll leave you with that. I know that you have you'll share my email address and
Yep.
those kinds of things. But if you're listening and want one thing to remember, learnaboutapartments.com.
Perfect. And we'll definitely put all that in the show notes, and learnaboutapartments.com will be a good way for people to connect. Listen, John, this was great. I appreciate your time today, everything that you shared. I think our listeners will get a ton of value out of this. I've learned a few things, found a few things that you mentioned really insightful. So I'm excited to continue this relationship and conversations in the future. So thank you so much for being on the show today.
Thank you for inviting me, Jason. It's been enjoyable. I really enjoy talking with you, and you have great questions, and love to share more things. Let's definitely do this again in the future.
Yeah,
it's been fun.
Folks, I know you're going to love this episode. Make sure you connect with John. He said learnaboutapartments.com. And please like, rate, and review the show so we can continue to get great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?